Broadcasting live from the Business RadioX studios in Atlanta, Georgia, it's time for Atlanta Business Radio. Brought to you by OnPay. Built in Atlanta, OnPay is the top-rated payroll and HR software anywhere. Get 1 month free at onpay.com. Now, here's your host.
Lee Cantor here, another episode of Atlanta Business Radio, and this is going to be a good one. But before we get started, I'd like to thank our sponsor, OnPay. Please support them so we can continue to share these important stories. Today on Atlanta Business Radio, we have Mark Buffington. He is with BIP Capital. Welcome, Mark.
Thanks for having me.
Well, before we get too far into things, tell us about BIP Capital. How are you serving folks?
Well, we're, over the last, I guess, almost 2 decades, we've become the most active venture capitalist in the region. We serve really 2 groups of people, investors who are looking to make outsized returns and entrepreneurs who are looking for capital and know-how in scaling their businesses. So that's how we do it.
Well, how would a firm like yours or any kind of VC firm help kind of their clients or their partners during this COVID time and with this transition of working from home, now returning to the office? Like, how does your company kind of help them, find the best practices, the best ways to kind of continue business despite the crisis?
Yeah, well, it turns out, I don't know if this is the same thing for you, Lee, but it turns out that I'm like 50% busier than I was, post-pandemic than pre-pandemic. So I don't know if it's because Zoom makes us more accessible, but or just the demands of what's going on in the world require us to be more active with our portfolio companies. But we're helping them in all sorts of ways, from the most simple of things like just allowing them to model our return to office policies and how we're handling that. All the way towards developing strategies to take advantage of the crisis or our competitors in the time of crisis, or is on the flip side of that how they can survive and stay alive during these tough times. So we are really, really busy with our portfolio companies, and I could go into much deeper specifics if you were interested, but that's the basic idea.
Well, what happened at the time when there was a realization like, okay, this is really happening. This isn't something out only in China. This is going to come here and this is going to impact us. How did your team kind of come up with a plan that's saying, okay, we need to come up with certain things that are going to help all of our portfolio companies be able to adapt and to kind of iterate quickly under this crisis terms?
Yeah, I think 2 things. I mean, so having done this now for 2 decades, we've been through a number of other crises, the Great Recession, the dot-com bust, kind of the accounting scandals at the beginning part of the millennium. So we had seen it before. And I think, we had a set of rules that we kind of operate off of during crises that served us very well. So, one thing is you have to make decisions quickly. You have to rally quickly. This idea of hoping for better times or that things will turn around quickly is not necessarily a good one when you're building venture capital companies and you're burning cash. But, our estimated burn is somewhat reliant on revenue. And so when you see, the market or customers having a tough time, they tend to cancel orders or delay purchases and all of that. So it shifts our forecasts, and we have to, be really prudent, and, usually means ramp down burn fairly significantly. So we did that, immediately. I think the other part of that was, in a weird way, got kind of lucky. My family and I were some of the early people affected in late February by the virus. And so we knew the severity and figured it was more than just, what had been like a SARS or an H1N1 type scare in the past, that this would be different. So we started preparing a few weeks earlier than maybe kind of mid-March. And I think that really helped us set the tone with our portfolio companies and the leaders of those companies. So, but we went all the way to a comprehensive review of the strategy, P&Ls, forecasts, cash needs, et cetera, of all 40 plus portfolio companies we had. And really within a month had shored up their balance sheets to give them, almost all of them, at least 2 years worth of cash runway if they needed it. So, been highly active during this period of time, and it's all about living to fight another day.
So now, on one hand, you're helping your portfolio company survive and weather the storm, but on the other hand, this must open up some opportunities where some other maybe great ideas but don't have the financial resources become available. Are you seeing some of that come into play right now?
Yeah, absolutely. So as I mentioned, we have a little over 40 companies. So when the pandemic struck and it became obvious that we were really in a crisis, we assessed both short and long-term impact, at least what we thought that would be at the time of the pandemic. And we assessed that 9 of our companies would be immediately and directly impacted by the pandemic, and the others really would be indirectly impacted by the pandemic. And so we, at least in the short term, and then we thought that roughly about 25% or a quarter of them would probably have an opportunity to improve their competitive positioning as a result of the pandemic, either because we felt like our competition was weaker and they would be eliminated, or we had some kind of advantage that we could exploit to really improve our market position. As it's turned out, now that we're 3 months into the pandemic, I think we were able to shore up, not to be boastful in any way, but all of the companies that I was worried about, all 9 of those that I was worried about, as being short-term directly impacted by the pandemic. And then, I think the 25% estimate of, hey, long-term, the COVID or the pandemic is going to help us, improve our competitive positioning. I think we were probably underestimated that. And I think probably closer to a third of our companies are now, emerging from this, assuming that we're starting to turn this around. And I think that's a big assumption, but we're really emerging from this in a better competitive position. So, all things equal, nobody likes to go through a pandemic or what we've been through, but I think from a competitive standpoint, we're probably in a better position. That said, we had to weather the short-term impacts of the pandemic.
Now, your firm does some work where you do like state of the kind of startup community, I guess. It's almost nationwide now, right? I know it's in the Southeast or in this southern region, but I guess it's expanding beyond that. Are you seeing, what are you seeing out there in the other markets outside of Atlanta?
I don't think our region is any different. The startup world is, at least in regards to dealing with crises and what happens to companies that are burning cash, when they encounter a kind of a macroeconomic crisis. I don't think there's not a different set of laws, macroeconomic laws here than there are there. So I see, a lot of pain. I think companies that, incidentally, the companies that were the highest flying, that were doing the best, and therefore started burning more capital to capture larger markets, I think they've had the toughest time, if you ask me, other than the companies that were just, doomed to fail before the pandemic anyway. But I think really the highest flying companies have had the toughest time because as we threw the brakes on the economy and purchasing and the like, they've had the toughest time adjusting quickly. And we're no different in that. We've had, imagine trying to convince a 30-year-old founder who was king of the world, in kind of early February that, hey, we've got to stop burning and spending so much money and going after this market as aggressively as we were. That's not a decision that's easily made, and there's a lot of ego and other things involved in that. So that's a lot of work to get them to shift their focus and maybe fly not so close to the sun. And so I see that across the country is that valuations have come in, expectations have come in. I think those companies that are able to maneuver through that faster are the companies that will emerge, in good health. Otherwise, they're taking on, a lot of risk. And so as I talk to my peers and colleagues around the country, we basically have the same set of challenges. How do you deal with your high flying companies? How do you make sure you don't run out of money? How do you still spend money on product, and improving products, but not break the bank while doing it? How do you emerge from this, in a better competitive position from a product standpoint, from a go-to-market strategy standpoint, all of that. I mean, those are the basic discussions that I have with peers all around the country.
Now, sometimes when there's a crisis, it kind of reveals some people that maybe shouldn't be playing at this level that they were playing at because of the market kind of elevates a lot of folks. Are you seeing that? Is there some shakeup out in the VC world? Are you seeing some consolidation in any way?
For sure. And that's kind of what I was referring to in the last answer to your question is that, those companies that, are hemorrhaging money that haven't been able to, kind of shift into a different gear and downgrade, are finding that the capital markets dry up a little bit, not entirely, and they're starting to come back, but they dry up. Access to capital at the same attractive valuations is not what it was, even for the best companies. And so, if you maneuver, along that path in the wrong way, it can put any company in harm's way. And, I think that's, we're certainly seeing that. I think the second effect that you kind of alluded to there was consolidation opportunities. And so one of the many strategies that we, discussed and are trying to implement as a result of the pandemic is if we're in a space and we're, either the kind of leader or, one of the two leaders in a given space, but we have other, smaller competitors in that particular space or vertical, rolling those up at attractive prices, not just to eliminate competition, but to capture synergy and, greater margins and operating and revenue synergy is, and even product synergy is, a big part of our strategy as a result of the pandemic. So we're in the middle of, I believe, 4 or 5 kind of mergers or M&A processes with our existing portfolio. And it's exactly the strategy you alluded to. So, I think those people that are on their toes and are have a decent capital base are going to be able to take advantage of the economic crisis. And, that's really what I said to all of our portfolio company leaders and founders at the outset of the pandemic was, look, you'll have every opportunity to panic. You're going to get knocked down. You got to get up and you got to keep fighting. You got to make tough decisions. But, at the end of the day, you're going to be presented with opportunities that, you never imagined you were going to see because of the pandemic. And, some of our very best companies were built in the shadow of a crisis, either the, Great Recession or some other, vertical specific crisis. And, if you're on your toes, great opportunity presents themselves in times like this. And I'm really proud of how our portfolio companies have responded during the pandemic.
Now, has it expanded your scope of what industries to go into or what kind of verticals? Are there now opportunities in areas that maybe wasn't a sweet spot for you in the past, but now you're kind of intrigued by them?
Well, just doing what I do for a living, always intrigued by other spaces. But I think if anything, the crisis gives us an opportunity to go deeper in the spaces we're already in, because we would consolidate or buy a company that has an ancillary or synergistic or complementary product. I'd say I haven't really thought about it until you asked the question, but I would say we're probably going deeper in the spaces and around the problems that we were endeavoring to solve with our portfolio companies. We're probably going deeper into solving those problems now post-pandemic than we were before. I can't think of a scenario where we've started looking at some space that we didn't have near as much experience in before. That said, we're getting opportunities to do that. I mean, the other thing that's kind of interesting is that when you enter into a crisis like this and capital dries up, all of a sudden we're getting opportunities to invest all over the world and in all sorts of spaces and in things that we never look at. And, it's interesting. I look at those plans and read them and think, wow, that's super interesting. Just a simple example of that is I just saw a plan for out of a different region of the country that we don't get a lot of deal flow out of for, essentially low cost rocket launching strategies. And so I thought that was I was like, how did these guys pick us to send this and ask if we would potentially invest in this? But I think that happens when capital dries up and people are, really turning over every stone they possibly can to raise money. So certainly we're getting more looks, but, we've stayed fairly disciplined and gone deeper into the spaces we know during this time.
Now, how do you help your portfolio companies kind of forecast ahead of this? Like, what kind of assumptions are you making about what kind of the new normal or future normal is going to look like, towards the end of the year going into next year?
Yeah, it's a really good question. So, obviously forecasting in a time like this becomes more difficult. And so, just in general, what we see is that sales cycles extend, renewals, the percentage of companies that, are renewing goes down. And predicting the degree of that is, gets difficult in a time like this. And so, we run just as a part of our basic, even in good times, it's just part of what we do with our portfolio companies. We always run a fairly standardized budgeting and forecasting process that allows us to say, okay, worst case scenario, only 50% of our, a given company's customers renew, or sales cycles extend by 3 months. Conversion rates, are not as high as they were before, all of those things. So sales go down, renewals go down. What does the world look like in that kind of, worst case scenario? And then we really build our budgets and cash flow forecasts off of that. And, if we perform better, great. That we'll have a longer runway and we won't have to raise as much capital. But it's just been my experience that, plan for the worst and hope for the best, and good things happen. But it's really tough to, think that the market will turn and to be, planning on the absolute best case scenario. And I think that's when companies get in trouble, is, when they think that, that the very best things are going to happen and they capitalize on that basis. And then that doesn't happen. They've made themselves vulnerable, and, capital markets can be tough, and they'll take advantage of that situation if you're not prepared for it. So, but those are the basic ideas. And so we're really, in our business models, looking at worst case scenarios and then capitalizing them and putting cash on the balance sheet on that basis.
Now, how do you advise the leader of a company to kind of make the most of this? Like, what should, when knowing that, okay, things are going to be slow, I'm not going to be able to sell as much, I have to conserve capital. What are some things I should be working on to really kind of not only just survive, but to thrive during this time?
Yeah, and it's a great question. I mean, again, when we called all of our portfolio companies together, we went through essentially a strategic and competitive review. We call it a terrain analysis, but really looked at a deep look at all of our products, our competitors' products, and how we could take advantage of, how each given company could take advantage of the situation and what we needed to focus on during this time. In many cases, it opened up all sorts of avenues that, frankly, were part of our thesis before the pandemic. I'll give you a great example of that in just a second. But they were part of our thesis before the pandemic. But then the pandemic and fear of the disease has accelerated some of the things we were working on, prior to the pandemic hitting. So a great example of that is telemedicine. We just sold a telemedicine business actually this week. That just saw just a tremendous explosion. We really made, part of our thesis was, that for a patient in a given location, let's say a rural location, to reach a specialist, it was really hard to drive 4 or 5 hours to a city. But if they could do that, over a telemedicine platform, that there was a really good market opportunity there. What we saw as a result of that is, that thesis ended up being right, and we were growing in a nice way prior to the pandemic. But post-pandemic, it also, that thesis was accelerated because people were scared to go into their doctor's offices, and so every doctor needed a telemedicine platform, and so we were the great beneficiary of that. So when we saw that coming, we had to make tough choices on supply. We had to make tough choices on bandwidth and how we were selling, and did we actually invest into the crisis? So we did that there. Another example of that is we own a digital ticketing business. And, for those, there's only been a few sports events since the crisis has hit, but I can assure you that, cash and other things where people are exchanging things, or they're touching hands, or, all those types of things spread disease. And so what we're seeing is all the stadiums, from pro level down to even little league, are moving to contactless ticketing. And so we had a play in that space, and it's accelerated it greatly. So in the short run, as I mentioned earlier, events got canceled and we didn't have anything to ticket. So, revenue is going to go down. In the long run, we sold more of our, and we are selling more of our applications because we provide digital contactless ticketing. And so, having the courage to invest into that, but living to survive another day is part of the challenge. So there's, I could probably name 15 examples like that where we were really positioned well for this, and it's accelerated the business opportunity. But, we've taken kind of a nose punch in the short term, and we have to fight through that. But, from a long-term perspective, we're in a way better scenario than we were prior to the pandemic.
Now, let's talk a little bit about hiring and the acquisition of talent. How are you advising your clients, and how would you advise businesses to handle that when there is less face-to-face and a lot of this? I guess it might be hard to onboard a recent graduate or something like that. How are you advising them regarding talent?
Yeah, I mean, there's both challenges and opportunities. I think from a pure cost perspective, and anytime you see, a recession or depression like this ensue, people lose their jobs. There's more talent available. There's less pressure on wages. And so areas where it was nearly impossible to hire people, prior to, call it March 1st, data science, certain types of developers, software developers, et cetera. I mean, that's really softened up. So, we've been able to bring in wholesale engineering teams to our portfolio that were either getting laid off somewhere. So they're teams that have worked together in the past. So that's created a positive opportunity for us. I think to your point, though, now that we're not all in an office together, even though I think for the most part, the world and us and our companies have adjusted very well to this kind of, Zoom style world, there's still something missing that needs to take place in an office, particularly around creative endeavors, or if you're building software or whiteboarding or solving problems. I find that, our companies are still trying to figure that out, particularly if they're onboarding a new employee. I think the other thing that's hard is, ingraining or, kind of engendering a new employee to a culture. Even in my own company, our team has done a great job of adjusting to just meeting by Zoom and talking by phone all the time. In fact, we're getting way more done. But long term, I'm a little worried about what it means for our culture, our fabric, how we work together as a team. And so we're trying to figure that out. And I think that's true of our portfolio companies as well. Now,
you do that report, this kind of State of the Union of Startups. Are you working on any other report right now as an organization to kind of get the lay of the land, or what you foresee in the, dealing with COVID?
Yeah, maybe you got a heads up on all that. I don't know if maybe our PR team is working really well on that. But so we've got some really good stuff coming out. We've kind of extended the report you keep referring to is called SOSU, so State of Startups, and then we run it for various regions. The one we publish most often is the Southeast report. And so we've done we've kind of for the last 3 years been focused on venture activity. So how many startups by state, what's happening in what sectors, how much money's going into those. Then we, the follow-on version of that, or the next chapter was, well, how are those dollars treated in terms of, what do they buy in terms of ownership of the company? And so what did that mean for valuation? This particular time we're now, this upcoming one, I don't think the team will care if I foreshadow some of this, but we're looking at where does real opportunity lie? And, what we're finding is that deals with a lot of momentum, regardless of region. So including in the Southeast, continue to drive greater returns. So the kind of the rich get richer is the idea. But interestingly enough, what we're also finding is that kind of two things. One is that there is a real opportunity. It's not something we do, but there's a real opportunity in vulture capitalism. So in other words, companies that didn't work out but built pretty good software, and then other people picking those up and then building them. It's really surprising if you look at all the data over the last 10 years, how many great companies have been built from picking up an asset that didn't quite work the first time. And so that was interesting and, frankly surprising. We don't have a strategy to do that. In fact, we've always kind of been momentum growth investors or growth at a reasonable price investors. So we kind of run from those kind of turnaround situations. But as it turns out, a lot of people are driving really nice returns doing that. And then the other thing you see is that certain regions really specialize in certain verticals. So in our own region, healthcare, IT, business to business is, software tools, things like that. So, BIP Capital, my company, has been a beneficiary of that because, what we've seen is we've been in the right spaces for the region. But then if you go look at another region, the Midwest or the Mid-Atlantic or Northeast, they just specialize and tend to build startups that are, in different spaces that are good, but not necessarily in the spaces that are good in the Southeast per se. And so that's coming out. It'll be a more robust SOSU report in October. We've also looked at the quality. We've really gone and we're not indexing incubators, but we're looking at the quality of companies coming out of incubators. And that has been, we'll publish something that doesn't demean or say anything bad about any of the incubators in town. But I think looking at what's coming out of not just incubators in Atlanta, but incubators in all of, cities around the Southeast, Midwest, Mid-Atlantic, et cetera, is really interesting. And, what you see is there's kind of a herding of success coming out of certain incubators. And it's certainly true in city by city. So that's a report, totally separate report that'll come out soon. And so anyway, that's a little foreshadowing. I could go on, but our research team has been very active during this time.
Now, if somebody wants to get their hands on that upcoming report or any of your reports, what's the website for BIP?
It's www.bipcapital.com. And the menus will direct them to not just the current reports coming out in October. I think we've got another one coming out in August related to the incubator study. So just follow the menus to get to those, but they can also see all of our historical reports as well.
Good stuff, Mark. Well, thank you so much for sharing your story today.
Yeah, always good to be with you, Lee.
All right. This is Lee Cantor. We will see you all next time on Atlanta Business Radio. And remember, we could not be sharing these stories without the support of our sponsor, OnPay. So please support them so we can continue telling these stories.
Today's episode of Atlanta Business Radio is brought to you by OnPay. Built in Atlanta, OnPay is the top-rated payroll and HR software anywhere. Get 1 month free at onpay.com.